So welcome everyone. My name is Franklin Chang. I am one of the TAPOC representatives representing our group here. Evelyn, who's from LA, Chloe, who's our professional chair, and Marianne, who's also from TAP LA. So we have 4 speakers today. Kevin Kuo, who'll be covering some of the exciting topics about how you buy your first home. Olivia Fu, who's from one of the private lenders, who will talk about some of the home buying processes and other lending tips. And Jack Wang, who will be covering commercial residential investment. And Jack Tsai, who will be talking about the BRRR investment models. And we'll follow up with some questions and answers that we have from our audience and some survey at the very end. And so if you could, for everyone, just make sure to continue typing in the chat for questions, and we'll answer that at the end. So with that, we're going to start with Kevin. Kevin is an experienced a real estate agent who's been working a lot in the LA area. Has been doing this for 7+ years. And he offers great services for everyone. He does a lot of investment practices, some 3D scanning, photography, and so forth. So with that, we're going to start with Kevin. Here he goes.
All right. Hey, everyone. This is Kevin. Yeah, Kevin Kuo. I'm a real estate agent and property manager here in Pasadena. And today I'm just going to be talking about 5 things that I think any first-time homeowner should know before they start the process. We're going to start off with the tax appreciation and tax advantages, all the way down to what are short sales and REOs. So let's get started. Next slide. So, like, besides the pride of ownership, just owning a home, a major factor for purchasing a home is the fact that the home appreciates over time. It can, and in California, it appreciates very substantially. I gave 2 examples here on this slide. If you account for a 3% annual appreciation, usually inflation is around 2.5%. So just assuming a house appreciates 3%, you can see that, like, if you bought a house for $575,000, you're appreciating close to $18,000 per year. And if you bought a house, even more expensive house, $750,000, they're appreciating close to $23,000 per year. So over a long period of time, you can see how that can add up, and you can really appreciate. You can really amass quite a bit of wealth just by holding a home, real estate for the long term. Moving on. So moving on, we're just talking about some of the tax benefits of owning your own home. The tax laws are always changing, so you want to check with your CPA or tax professional to double check this. But as of now, this is what the current laws, as of my knowledge, that you can apply to buying your first home. Annually tax deductible. You can deduct your interest on your mortgage for loans up to $750,000. Your property taxes up to $10,000 a year can be deducted, and then even the depreciation of the building area used for your home office. A lot of people are working from home now. That can be deducted as well. When you buy real estate, 3 major taxes you have to look out for, the government wants to take from you, is capital gains, inheritance, and capital gains, inheritance, and one more. We'll go over it as we come along. So capital gains tax is basically when you buy something and you sell it at a higher price. If you buy a primary residence and you live in there for over 2 years, if you're a single individual, the first $250,000 is capital gains exempt if you sell it. And then if you're married, the first $500,000 is tax exempt. Now, this only applies to primary residence, homes that you have lived in for 2 years and up. If you decide to rent out this house after you rent it out for 3 years, it doesn't apply. So what I'm talking about today is mainly just for homeowners, for properties that you personally live in yourself. As of this year, property tax laws have changed. According to Prop 19, if you're age 55 and over, you may sell your home and transfer your property tax assessment to a lower or equal value replacement in California. So what this means is, like, in California, when you buy a house, your property tax is set. It's set at the price that you purchase it at. But then what happens is, as properties gets higher, a lot of older people, they can't afford to buy a new house because the new home has a much higher property tax. What this means is that you can keep your existing property tax for a replacement home, and you can keep doing that up to 3 times. I'll give an example in a little bit. Another thing is inheritance tax. Your heirs, okay, when you die, enjoy no federal inheritance tax for properties up to $11.7 million. And they also enjoy a stepped up basis for inheritance property. Basically, it'll be covered in the next example. Heirs enjoy no property tax assessment if they own or occupy the properties that they inherit. So let's move on to next slide. So here's an example of a property that I personally know, because I grew up in Arcadia. In 1990, my parents sold a house, and they sold it for $460,000. If the new owner, let's say he was 25 years old in 1990, bought it at that price, he'd be paying property tax equivalent, $5,700 a year. Fast forward 30 years later, in 2020, he's now 55 years old. If he decides to buy another home in California, Prop 19 allows for him to sell this home, which is now worth approximately $1.2 million, to buy another home of equal value, $1.2 million, while enjoying his original property tax, the $5,750. He doesn't have to pay the new property tax for the new, more expensive house, and he doesn't have to pay any capital gains tax. Let me see. When you live in a home, let's say he lives in that home until he dies. Let's say he lives in a home until he dies, and the house is now worth $2 million. The heirs now enjoy no inheritance tax because it's less than $11.7 million, and the heirs enjoy a stepped up basis, meaning it'll be as if they bought the property at $2 million. So they can sell the property at $2 million and not pay any capital gains. And if the heir decides to move into the house, they can even enjoy the original property tax assessment at $5,750. So you can tell from an investment standpoint, buying a home and holding it for the long term is very, very beneficial for not just you, but your future, your heirs and your family in the future. Moving on. So how do you buy a home? The first step is to get yourself pre-qualified, because the market is so competitive right now. You basically can't even look at a home without getting a lender's pre-qualification letter. So when you before you even look at a house, talk to a lender first, and then find out how much you can actually borrow. The common items you'll be looking at is your down payment, how much you're going to put down for your loan, your interest, your monthly payment, which is made up of the principal, basically how much you pay back your loan every month, their interest, how much they're charging you to borrow that money, the property taxes, and the insurance, and any loan fees that your lender will charge to loan you the money. They're going to base your loan on your past 2 years income, your current debts, like your car loans, student loans, your current credit score, and your savings. Moving on. So after you talk to your lender, you'll be able to come up with your price criteria and how much cash you actually need. For example, your price criteria might look something like this. You want to purchase a home for $725,000. Your loan is 30 years fixed rate, so your loan doesn't change for 30 years. Your interest rate is 3.1. 80% of that 725,000 is your loan, is your mortgage. Now, you have a comfortable monthly PITI, monthly payment around $3,300, and then your home budget, which is how much it would be, how much cash, physical cash you'll need to purchase the home. You'll need 20% down payment. So we're looking at, if your home budget is $165,000, you have a $145,000 down payment. You need to allocate also cash for your closing costs, your loan fees, and any minor repairs you may have. I typically allocate 2.5%. It's usually 2.5% in the past. My closing costs and loan fees and any minor repairs is always around 2.5% of the purchase price. And then you also have your reserve, which is money set aside for unforeseen items. Now this does not include, your home budget does not include your emergency fund. And experts always advise that you set aside 6 months of emergency fund to make your payments in case something happens. So this 165, your home budget should, that should be outside of, this should be just for your home, and it's not your emergency fund should be another account. Next slide. Oh, man, am I going too slow? So once you have your price criteria, now talk to your local agent, and work out your home and your location criteria. Usually your house criteria and location criteria, you have no problem like figuring out. You know exactly, in my experience, my buyers, they know exactly what they want, how many bedrooms, whether or not it's 2 stories, if it's how many suites they need, what year build they want, move-in ready, or how many garage, what kind of neighborhoods they want, how close they want to work. What you want to do is work with your agent to figure out the best case scenario so that all 3 criteria are satisfied. Because from my experience, you can usually only satisfy 2 of the 3 criteria. The house is the house is good, the location is good, but it's too expensive, or it's the house is good, the price is good, but the location's on like a busy street, or the location's bad. You don't like the neighborhood. So work with an agent to find a good balance so you can satisfy your house, your location, and your price criteria. Next slide. Now remember, your list price, the list prices that you see online, those are like marketing prices. And it's like clickbait. It's like prices that people put up to attract buyers. That doesn't mean that the market price is that price. Work with your agent to come out with the market price, which is based on the comparable sales around the listings that you're looking at. I always recommend doing that even before you see the property, so that you get a better idea of what this property might actually sell for. A lot of times, sellers will just put their property, they'll list it very much undervalued, and they attract a bunch of buyers, and then even if they get the price that they want that's listed online, they won't sell it. So work with an agent to determine your market price before you go and see it. And another thing I would recommend is you always want to look below your budget, so you can allocate extra reserves for things like bidding wars, appraisal issues, and unforeseen repair issues. Next slide. So the last section has to do with probates, short sales, and REOs, because a lot of people they want a good deal. They want to buy a house. They want to buy their home at a good deal, and they ask, "Can I get a good deal if I look at probates?" These are properties owned by where the sellers died, and then the heirs are selling it. Short sales, where the bank owes more money. The seller owes more money to the bank than how much the bank owes lent to the seller. And REOs are properties that the banks basically foreclosed on and are selling themselves. You always want to know the correct answer is it depends on the problem. See, good deals come from problems. There are good problems like cosmetic issues, systems issues. If you just need to change the AC, change the water heater, those are actually good problems to have in a home. Bad problems are things like location issues, things that you can't change, like safety, structural issues. Those things you cannot change. And regardless of the seller being a bank, an heir, corporation, they all want the most for their property. And it's up to you and your agent to go visit the property and determine, is this a good deal? Does this deal have good problems or bad problems? Because yeah, you can have short sales, REOs, but if the house is great condition, location is great, it's going to sell just as high as any other house that's listed, you know, with those characteristics. So that concludes my presentation. My name is Kevin. I'm out here in Pasadena, California. You can find me on Facebook, Instagram, and YouTube at Realtor Kevin Kuo. If you have any questions, feel free to give me a call. I think I'll be happy to help with any type of real estate needs you might have. Thank you.
Awesome. Thank you, Kevin. I'll have Evelyn introduce Olivia.
Okay, so now we have Olivia. She's a mortgage lender for First Commercial Bank, and she's going to be talking about the financial aspects of real estate investing. So now we have Olivia.
Hi, everyone. My name is Olivia. I'm very happy here to see all you guys. Okay, First Commercial Bank. Would like to introduce a little bit the education of first-time home buyer program. Buying your first home is very exciting, but I would like to start to see your financial stability. Next, let's move on next. And next, yeah. So fixed interest home loan payment remains stable year after year, as opposed to rent payment, which may increase year after year. Since the salaries generally rise over time, the fact that mortgage payment remains steady over time can help you manage, plan, and grow your wealth. Let's move on next. Here I have some information to help you home buyer advice and education. The U.S. Department of Housing and Urban Development, which we call HUD, sponsor housing counseling agencies throughout the country that can provide you with advice on buying a home and resolving the credit issues. These services are offered at a little or maybe no cost to you. To find a provider near you, visit the website consumerfinance.gov. Especially you want to pay as low as 20% down payment. Sometimes people are looking for 3% down payment, 1% down payment. This website can help you a lot. Let's move on next. So let's start the home buyer process. Once you've made a decision to buy a home, you may ask yourself, what should I do first? Here is the process. Okay, let's move on next. Step 1, collect the financial records. A lender may evaluate these records to determine your financial stability, credit worthiness, and ability to repay the loan. Let's talk about the PITI. When evaluating your future housing expense, it's important to take into consideration the entire housing expense, not just the mortgage payment. Mortgage lender use PITI calculation, which include the principal, interest, taxes, insurance, to determine the total monthly housing expense. Homeowner association fee will also be added to the calculation. When applicable, the PITI calculation will be used as one of the components of the debt to income ratio. So when evaluating your ability to repay the loan, the lender will calculate your debt to income ratio, or DTI. The DTI is your total minimum monthly debt, which not only include the PITI, but also include your credit card, student loan, car payment, etc., and divided by your gross monthly income. Gross monthly income, not net monthly income. The lower your debt to income ratio, the higher the likelihood of getting the home loan terms you want. Now talking about the credit score. A credit score is generated by a credit reporting agency that is calculated from several pieces of data. In your credit report, both positive or negative information is considered in the calculation, including payment history, amount owed, length of the credit history, and type of credit issue or credit used. The higher the score, the better your loan rate are likely to be. Let's move on next. Evaluating your home loan options. When you are shopping for a mortgage loan, of course, First Commercial Bank will be able to provide with you a wider range of home loan options. However, it is very important to work with a mortgage professional who you feel comfortable with and who you feel you can trust. Once you've decided on mortgage provider, make sure that they can answer all your questions, provide an option to meet your financial need, and that they clearly explain all the fees and costs associated with the loan. Ask for any loan information in writing. Your mortgage professional can help you identify any credit issues that may hinder a loan approval, guide you through the loan application and closing process, help you determine a home purchase price that you can afford, help you compare different loan programs so you can choose the best one for your financial needs, manage and address any issue that might come up along the way. So let's move on next one, know your option. Many factors affect your loan payment, closing cost, and the amount of cash needed at closing, including whether loan is a fixed or adjustable interest rate, number of the year that you will be making payment, down payment amount, mortgage insurance option, and fee. Don't be afraid to ask a question so that you can fully understand the impact of these factors on your home loan. Let's move to the next. Ask a lot of questions. For example, what's the difference in monthly payment between a 15 years and a 30 years term? While 15 years term, you will result in a higher monthly payment. You may qualify for a lower interest rate. Plus, you will be finished paying for your home in half the time, saving a significant amount on interest payment. For example, you may ask, what interest rate will I qualify for it if I choose an adjustable rate mortgage? Usually the adjustable rate mortgage have a lower starting interest rate, resulting in a lower initial monthly payment. But adjustable rates tend to increase over time. However, if you plan on staying in a home for only a few years, this might be a good option for you. How will mortgage insurance affect my monthly payment, and how long will I have to pay? Mortgage insurance reduces the down payment requirement for the borrower, but it will increase your monthly payment. Depending on the type of loan and the specific insurer, you may be able to eliminate the mortgage insurance payment once your balance drops below a certain level. So let's move in the next, finding your home. The house hunting stage can be fun and exciting, but it is important to keep your priorities in mind when evaluating potential home. Kevin has mentioned about it. You may have to look at a dozen of homes before you find one that is in a neighborhood that suits your lifestyle, is within your budget, and has all the features that your family desires. You should be prepared to readjust your priorities to find a home within budget that fits all of your needs. Okay, let's move to the next. Working with a real estate agent is important. Kevin has mentioned about it. A real estate agent can be a great asset in helping you find your dream home, reviewing your wish list, and researching potential home, making arrangements to show the home that fit your requirement, negotiating a purchase price, and making the offer. This is important because the seller wants to get the maximum amount for their home, but you will want to pay the lowest cost possible. And also, real estate agent assisting you in the purchase and closing process. Let's move to next. Okay, buying the home. Once you find the perfect home for you, it's time to making an offer, finalizing the mortgage loan process, and close the sale. Making the offer, your real estate agent can prepare the offer on your behalf. The official offer will include the information about you, the seller, the property, and the special provisions, the purchase price being offered, and any contingencies. Your offer will be accepted or rejected, or you may receive a counter offer. Your offer will likely include a deposit, which will be held by the seller's real estate agent or lawyer until the sales close. The sales contract then will be drawn up. The sales contract is a legal and binding obligation on the part of the buyer to purchase the property if the contingencies are met. So we closing the sales. Once your offer is accepted, you begin the process of closing the sale. They involve several important steps, many of which can hold up or even prevent the purchase of your new home. It is critically important to remain in contact with your real estate agent and mortgage professional so that you can respond to any request for information or additional documents as quickly as possible. Contingency. There are contingencies that will need to be met before the sale can close. These are itemized in the sales contract and can include things like the buyer securing financing and an acceptable home inspection, among other things. Home inspection, a professional conducts a thorough examination of property to assess its structure, mechanical condition, catching any potential problem that a buyer may not detect. This process is cost that you will have to pay at the time of the inspection. Often, an inspection will turn up problems that may become part of the negotiating process. You may want the seller to fix the problem or discount the price to allow you to fix it. Your real estate agent will guide you through the part of the purchase experience. Okay, let's go to the settlement statement. This statement documents all the funds paid at the closing, including itemization of all the fees and charges that the home buyer and the seller face in the sales transaction, also known as HUD-1, Part 1. This is a standard form developed by the U.S. Department of Housing and Urban Development. it's important to check this document carefully for accuracy and ask the question if there's anything on the form that you don't understand. So let's close in the document. Closing document consists of various standard documents that must be complete before a sale can close. This can include a title research to confirm the title is clear, title insurance to protect the buyer and the lender from an error resulting in a claim on some aspect of the property, and an application of homeowner insurance. After all above items are complete, now is your time to close the sales. You will sign all the closing document. Trust me, it's more than 100 paper. There will be many documents to sign, and the title of escrow company will be happy to answer question for your pet. Congratulations, you got your first home. So that's all about my presentation. And let's move to the next. Please contact me if you need any further discussion or you have any question, especially you want to pay as low as much down payment. You can contact me. That's my phone number. And here is my email. You can also WhatsApp me or line me. Okay, thank you for inviting me here.
Thank you. Thank you, Olivia. So we'll be introducing Jack Wang. Jack Wang covers in the Orange County area. He's been doing this for over 20 plus years in residential and 10 years in commercial investments. So he'll be covering about things about the client's startup, how to build up their portfolio, and we'll continue from there. With that, Jack.
Let me see. Okay, everybody hear me? Okay. Okay, my name is Jack Wang, work for the Realty One Group. And today we start for the commercial and the investment. Okay, basic of the investment commercial. When you see the loan name or any commercial web, you can see first one, triple name. What means the triple name? Triple name means the landlord is paying nothing additional cost, and tenant will pay all costs for the property. Like first end, we say tax. Next is insurance. Three is we call claim charge, like maintenance. Okay, those three is a tenant to pay. And when the investment sees a triple name, that means you pay nothing for extra cost. You just correct the rent and got your cap rate. Okay, so every first time investment for easier, I can suggestion buy the single building. Why you buy the single building? Because the single building 100% that's triple net lease, and you know the rate of the return investment and cap rate. For example, next please. Okay, we see here. Okay, the best name like a McDonald. Okay, that's more safety. Everyone know McDonald will pay you rent for on time, right? So McDonald, Starbucks, okay, their rate is very low. Why the rate is very low? You look at that the cap rate is 3% to 3.5. That's all. They cannot over that. Okay, Starbucks 3.5 to 3.75. Any fast food chain like Carl Jr., like Jack in the Box, that's 4 to 4.25. But if you have more money, you want to invest like a CVS, Walgreens, something, you may got the cap rate for 5 to 5.25. But that one CVS normally is 8 million to 20 million to invest. Okay, And next one is a 7-Eleven. Like 7-Eleven, the single building, they may asking 4% only or less. But if the 7-Eleven with like a 4 unit to 8 unit, they may can up to like a 5%. The next one we say the warehouse. Warehouse, they have the warehouse condo or individual warehouse. Their cap rate normally can 4 to 5%. Depend the landlord, they need the money or they not need the money. Okay. Also, I needed to tell everyone all the commercial, they may have the 1031 exchange. If you don't know the 1031 exchange, just call me. Okay. Then hotel is we say like a chain store normally is 15 million to 4 billion. Like we say Vegas Bellagio, that's 4 billion. That's huge money. Okay. Next one, please. Okay, this page is a basic investment for personal. Know the difference for response between buy house or landlord. I suggestion, just Olivia said, choose a local senior agent to help select house for the invite. Why? Because the senior agent and local agent, they know school district, they know neighborhood, they know the city community. Okay, that one is the base to help to invite everything. Just for example, we say Irvine. When 1988 you buy the 250,000, how much for now? Over the 1.3 million. That's you had over 1 million for the benefit. Okay, like you go to by the Texas, I have friends from the Texas move to the Irvine. When they buy Texas 5,000 square feet, only 300,000. But what's right now the value? Only 350. So you want to make 50,000 or you want to make 1 million? That's your choice. Okay, how much you want? By the way, the all investment or buyer, you need to tell your agent what you desire, the rate of the return, and what the city you wanted, because that's easier for the agent to help you to get the deal. And remember, the higher rate of the return should be higher risky and lower value for increase. Just like if you buy like a Riverside, okay, you may lose your money for the 2006 until now. But if you buy the Irvine, they may double, triple your income. So you need to choose. You want the high cap rate or you want the stable. Okay, next please. Okay, cap rate and how to calculate. For example, we say the Irvine single house. Okay, for the when you buy the 1 million, then your monthly rent it should be $4,000. Then your annual rent is 48,000. Okay, you pay the tax around like 13,000. You pay a whole year HOA fee like 1,440. Okay, then your NOI is use your rent minus your property tax minus HOA equal, you got the 33,560, and use that number to divide the 1 million when you purchase. So your cap rate is 3.5 return. Thank you. For next, please. Okay, last one. Home buying process fun fact. Okay, this very important for all the non-resident in United States. Everyone, every age, they can buy a house in United States. But you must be over the legal age of the 18 to sell the house. Okay, if the owner not based in US, you still can sell your house or property in United States, but you must go to the local US embassy to notarize the document and send you back to US escort can be trade. Okay. And the close escort date determine the real estate tax and HOA fee. And all the buyer need to know when you open the escort, you must be do it. You send your deposit to escort and loan information within the 3 days. And buyer, after inspection, you have to present your require of the repair to the seller. Also, seller will send you transfer disclosure statement within the 70 days to notice the buyer that like a house condition. Then buyer can cancel this transaction within the 17 days when you not satisfy all the document or information, and also you can get the deposit money back. Okay, I'm finished. So if you have any question about the commercial, I very welcome to call me or email me, because commercial is very, very difficult for the deal. They may like the last thing I talked to the like a restaurant, you buy the 2,000 square feet, okay, for the office building, individual building, but you want to change it to the restaurant. Is it possible? No, because every restaurant, they require 1,000 for 10 parking space. If you buy the 2,000, you only have the 10 parking space. Even you have the 14 parking space, you cannot change to the restaurant. So they had the last regulation. So you must be call me to help you to the investment. And the parking space, that's very, very difficult. So I welcome everyone to email me for the commercial question. Okay, I'm finished.
Excellent. Thank you, Jack. And I guess Evelyn would introduce Jack Tsai.
Okay, so then now we have Jack Tsai. He's another agent in the LAOC area. So he's going to be talking more about real estate and the investments. So here we have Jack.
Hello, can you guys hear me? Good.
Yep.
Good morning, everyone. My name is Jack Tsai. Thank you so much for Kevin, Jack, and Olivia's great presentation. You guys have any purchasing property, investment, commercial, getting a loan, feel free to, definitely contact them. A little background story of myself. My name is Jack Tsai again, and I got into the real estate industry about 12 years ago. I'm currently 36. And I know that a lot of the audience here are maybe first-time home buyer or someone who want to invest into real estate property. And I think one for me, I would consider myself, I started it when I was in college, when I read the book Rich Dad Poor Dad. I'm sure some of you guys read it, and for the one that never read it before, I highly encourage that book. It's called 穷爸爸富爸爸 in Chinese. And I read that in college, and that really changed my mindset a lot. And it taught me a lot of things, which I'm going to talk about 2 of them shortly. So it helped me to think like that I don't want to work for someone else. I want to be an entrepreneur. Regardless, even if I were to work for someone else, I'm going to invest into real estate or some whatever vehicle that I want to leverage. So here on this slide, you guys can see that in one of the concepts he talked about is that the poor people, they have income. They have a job, they have income, and then they spend it. And then they don't have anything afterward. And the middle class people, they will have income, they will invest, they will buy stuff which they think that it's a asset, but it's actually liabilities. Things are like car loan, student loan, and things like that. And the wealthy people, they actually have income, and then they invest into asset, which bring them money. So his definition of asset and liabilities are asset is things that put money into your pocket, and liabilities are things that take money out of your pocket. Okay, next slide, please. So one very important concept is there are 4 quadrants of people. One of them is employee. So you have a job, as you can see. You're on W-2, you're trading time for money. And such as like if you work in a restaurant, or basically you have a boss and you get a set pay. And then self-employees are you own a job, such as myself, I'm a realtor. And for like maybe like dentists or like attorneys, they have their own job, they get their own pay, right? But they're also trading time for money. And so the goal is to get from the left side of the quadrant to the right hand side, which is to become investor, which is what we're talking about today, and where you use money to create more money, such as like if you invest in real estate, you do a stock, or like a YouTube channel, or you write a book, you create music, stuff like that, right? And the other one would be business owner. So you own a system where people work with you. So it could be like if you own a McDonald's franchise, basically definition would be where like you own a business where even if you were to go on vacation for like a month, money will still come in. So if you own a McDonald's, I think it used to cost $250 or something like that. I don't remember how much, maybe Jack can answer later. And you own it and you don't have to be there. Or if you work for like a network marketing company. Okay, so we want to move from the left hand side to the right hand side. Next slide, please. So today we're going to talk about active income and passive income. And so active income, since we're talking about real estate today, there are many ways, like your job, or like whatever you do, even like for example, if you work for Uber, whatever, just basically whatever you do is trading time for money. But in real estate, we're talking about wholesaling and flipping. So what wholesale means is that basically you find properties that's not on the market, or maybe even on the market. For example, if you buy a property for $400,000, and then like after you repair it up, you fix it up, you flip it, it could be worth, let's say, $600,000. And then let's say you can acquire that property for $400,000, and then you want to sell it to a flipper for like $420,000. So what that means is that you don't have any money in the game, you don't have any skin in the game, but you can flip it, the contract, for just $20,000 in return. And so that's wholesaling. Flipping is where you can, using the same example, you purchase a property for $400,000, and then you remodel it, maybe spend like $50,000 to remodel it, and then you sell it for $500,000. So you have $50,000 in profit. And so those are active income. You still gotta keep on doing it so that you have more income. And passive income, or you could do something like syndication, where you can, they also call it crowdfunding. So where you can find project and then find a bunch of people, and then they all pour in money, and then you guys split the profit. Or you can, on the reverse side, you can be the investor, and where you can put money in, and then they will give you like money from a loan, usually quarterly or annually. Like for example, I did a syndication a couple of years ago. I put in just 10 grand, and then every year they will give me about $1,000. But the thing is, it was like I think 300 some unit project in Arizona. And then after like 2 years, I think they refinanced. And then they gave me like $8,000 back. So I have a really high return based on that, right? And another one would be buy and hold. So where you buy property and then you collect rent. So I recently helped a client because I'm a full-time realtor, and regularly like people will come and say, hey, Jack, I got some money, I want to invest into some real estate. So recently there were like 2 clients that I have actually. They say, oh, I got like $200,000 and I want to invest into some real estate in California. So we're able to help them find a property in Ontario. The price was like $420,000, and they were able to rent it out for $2,500. And recently we helped another client who were like, hey, we want to buy Airbnb property. So we helped them to buy our property in Big Bear. And then after all the costs, like calculating 50% vacancy, we're able to get them about $1,500 in passive income every month. So, and the third model would be the Burr model, where I'm going to talk about a little bit in detail in a little bit, but where you buy a property, collect rent, and with infinite return. I saw in one of the questions earlier, people were asking, how do you refinance? That's what we're going to dive in a little bit. Next slide, please. So the Burr model, basically what the Burr model means is that you buy the property, you remodel it, and then you refinance it, and then you repeat the process. Sorry, there's a rent it out, I didn't type it in, but you buy the property, you remodel it, you rent it out, you refinance, and you repeat the process, right? So where you buy the property under market value, like the example I gave you earlier, and then you can add value to it, or maybe add square footage to it, or add an ADU to it. So what ADU mean is accessory dwelling unit. Is pretty much kind of like a duplex or even a triplex. Like you own the property in the front, and then you can convert the garage into a living unit, or you can build another unit in the back. So I'm going to give you one example here. And there's a 70% rule. What that means is that ARV, the after repair value, times 70%, and it has to be equal or less than purchase price and rehab cost. I'm going to give you an example here. So recently we help a client. Actually, my partner, he just bought it, a property in Baldwin Park. It's a 3-bedroom, 2.5-bath condo. The after repair value is $420,000. And he was able to buy at $200,000. So the reason being, you may be asking, oh, why can they buy for so cheap? So reason being, because we talk to a client, like we prospect every single day for people who, especially owners who are thinking about selling, things are off the market. And for this specific seller, they're like, they're older people, and then they're like, they just want to get it done. They don't even want to put it on the market. And then my partners decide, how much do you want? They say if they can clear $200,000, they will sell. They'll walk away. So my partner bought it at $200,000 with hard money loan. So what hard money loan is like, because Olivia mentioned about getting a conventional loan and different program that she had. And if you guys have any lending question, definitely go to her. But what hard money loan is that basically you can acquire a loan with like 20% down, and then they will lend it to you without checking your documents whatsoever. But the catch is that the interest rate is much higher. Right now, the rate is a little above 3. It's still very, very low, but recently came up a little bit. So recently, right now it's about like 3.125, somewhere around there. And every day is moving, right? But hard money, you're typically going to be getting about 8 to 12% interest rate. But the benefit of that is that they don't check anything, because typically the bank want to check your tax return, your income, pay stub, FICO score, and everything. And typically, regular conventional loan, it could take about 21 to 45 or 60 days. But hard money loan, you can get it done within a week, sometimes 3 to 7 days. And so what he did was that he bought it at $200,000. He got a hard money loan. He put 20% down, which is 40 grand. And his closing cost, he paid for the closing cost for the seller. And so it's just 20 grand. And then he spent about 30 grand to remodel the property. Just cosmetic, mainly. It's just because whatever property, if you want to buy, like if you pretty much like, as long as he doesn't have too much like plumbing problem, I tell all my clients that whatever property, if you're buying, whether or not it's investment or primary properties, you want to look at 5 things. Number 1, roof, foundation, plumbing, utilities like electricity and all that stuff, and AC unit. Okay, so water, electricity, roof, foundation, AC. Very, very important. Right. So as long as there is, for this property, it doesn't have those problems. So he spent about $30,000 to do the kitchen, bathroom, and if you paint and do the flooring, you basically look like a brand new home, right? So he was able to, his total cost is $250,000. So his ratio is 59%. Basically, if you divide 250 to 420 is 59%. As I mentioned earlier, the 70% rule, basically this property is a home run. right? I'm not saying anyone and everyone can find this property like every day. It comes occasionally, right? If you can find a 70% rule, it's good. It's very good already. So basically, he was able to get an instant equity of $170,000, and then so he bought it, he remodeled it, and then he rented out, and he refinanced based off the $420,000 at a 75% loan to value ratio. So what that means is that if a property is worth 420, and then you refinance, the bank's gonna finance you, still want you to put 25% equity in there. So he was able to refinance 315, which covers the 250 where he put in. So he got his whole entire down payment, all the investment back. The best part is that he was able to rent the property out around like $2,490. So I just rounded up $2,500. So he got about 30 grand a year, basically infinite return. Right, next slide, please. And so there are a lot of different ways to get money lately, whether it's active or passive income. And one thing I tell my client as well, very important, and I've been through the process because I started when I was 20, after I graduated. And I remember along the process, I'm like, okay, what am I gonna do? Like where am I gonna get money? Like, how do I get active income? How do I get passive income? And I remember I getting lost along the way. I'm 36, by the way, so I've been in it for about 12 years. So one thing I tell all my clients, very important, is that whatever you want to do, whether you're a self-employee, employee, investor, whatever, like have an end goal in mind. What that means is that we gotta know how much passive income we want to have when we retire, right? So I definitely encourage everyone here to have a number. For me, I know that if I can have $15,000 a year, a month, a month, I can live a pretty decent life, right? Everybody's number is different, but I'm talking about debt free. You don't have to pay any car, any house loan or student loan, anything like that. So have that number, and once you have that number, I'm going to use my example, 15 grand. So you got to think about which vehicle you're going to use. Are you going to use real estate? Are you going to use stock? Are you going to use create some business or own a McDonald's, whatever you want to do? Figure out. That's for the sake of this conversation. We're talking about real estate, right? Because all of us the speakers are real estate professionals. If let's say we're going to do real estate, then think about how much average, find out, or you can talk to any of us, find out the average rent in the area where you want to invest in. So let's say your number is 15 grand. So my average rent in the area where I want to invest in is about 2,500. So I then need to have, if I were to only use the real estate, then I need to have 6 properties before I retire. And then, so from there, you talk about how many doors you need to have, right? And you can also leverage other programs as well, like maybe like network marketing, whatsoever. Goal is to just know that number so you know what you can do to get there. All right, next slide, please. So in summary, today we talked about the Rich Dad Poor Dad. Again, for those of you that never read it, please, I would say it's a really good book. Read that book. And you talk about in detail. It's a very easy read, right? And we talk about having active income and passive income. There are many different ways, and knowing your number. Next slide, please. So what do you do next? If you have any questions, what we do, actually, I work with Kevin. So we help client to look at their portfolio. We never hard sell, tell people, say, hey, you gotta buy, you gotta sell. We look at our client's portfolio and let them know based on their end goal, so that we can help them tailor a plan to either keep their property. Like recently there was like a client that came to me. He's like, oh, I got a property in Diamond Bar, I'm thinking about selling it. And then, so I told him, we looked at the number and we're like, you know what, just keep it as a rental. It's a good rental property, and then just keep it. And because right now, like there's just shortage of inventory in purchasing in rental market. So he's keeping it. So what we do is that we help people to really look at it based on their end goal, so we can plan it for them, right? To either sell their property to get a better property, or sell their property to find something different vehicle, or to buy another property to upgrade, downsize, or invest, right? At the same time, me and Kevin work together. We help realtors. If anyone, I know if you guys are thinking about being a realtor or like changing brokerages, like we help I currently sell about 30 homes a year. And I work with my partner. He sells about like 120, 150 homes a year. So if for anyone who is in the real estate industry, they are thinking about like creating multiple streams of income, whether through real estate, whatever vehicle, feel free to follow me or DM me on Instagram, Facebook, YouTube. And we also do a Clubhouse chat on Monday and Wednesday. Actually, I don't know my Clubhouse handle, but you guys can find me. You can just message me, I'll let you know. And or you can call me, you can message me as well. And thank you so much for giving me the opportunity to present. And if you guys have any questions, just email or message any one of us. We'll be more than happy to help. And we'll address the question that you guys have in the chat box in a little bit. Thank you.
Awesome. Thank you. Thank you, Jack. So with that, Chloe's going to start our questions and answers. So we have a few that came from our group. So Chloe, go ahead and take it away.
Sounds good. So hi, everyone. My name is Chloe. We'll be first going over the most common questions from the ones submitted in the form that you signed up for this event for. And then it'll be about 1 minute to 2 minutes per professional for one question, or 30 seconds each. And then at the very end, we will be going over the questions from the chat box that you guys submitted. And thank you to the people who have helped answer, David, Gary, Jack, for all pitching in. It's super duper helpful. So the first question we'll be going over is in home categories. Kevin went over this a little bit in terms of how much do you really need to save up to purchase a home, but in the OC LA area. And what are your tips on choosing a realtor? I think if we have one person from LA and one person from OC to answer this question, that would be great.
Who want to take it? Kevin, want to take that one?
Oh, okay. I guess I'll take it then. You know, how much do you really need to have saved to purchase a home? That's a really good question, and it really depends on your situation. In my presentation, I went over you need at least just for your house, your home budget, you need at least, you need your down payment, whatever it's going to be, 5%, 10%, 20%, 50% down payment. You need to have enough money for your closing costs and your loan fees, which would be additional 2.5%. And you'll need some reserve in case things happen, in case there's a bidding war, in case there's unforeseen repair issues that come up after you do your inspection, and then in case there's an appraisal issue, is what I'm seeing right now. It's like the appraisals that the banks, when you have a property in escrow, when the lender comes in and have their appraiser look at it, the appraised price hasn't caught up to what the purchase price is. So you will need money to make up that difference between what you were originally agreed to buy the house for with the seller and what the bank is willing to lend on it. That need reserve. So it really depends on your situation. And all on top of that, you should have your 6 months emergency fund. Tips on choosing a realtor. You definitely want to choose someone that works fast, that will have you will put you first and negotiate hard for you, because right now the market is super competitive. You have to be fast. A lot of listings are just on the market for, they would say, like, you see the days on market, you'll see listings in less than like 10 days on market. But whoever you choose, you gotta be someone that you can work closely with to analyze your needs, like what Jack said, have you in their best interest, and then just be able to negotiate hard for you. Yeah.
Awesome. Thank you so much, Kevin. I think in the interest of time, I will be moving on to the next question. Those are really good insights. Definitely reach out to a realtor you feel comfortable with and really discuss what your budget is and everything that factors into, because there's not really one solid, you need to save 500,000 in order to buy a house. Okay, so the next question is, what do you think are up and coming towns to invest in, since a lot of the major cities are saturated and are very much competitive?
I can take it. I would say typically because I personally invest out of state too, what I look at, I'm in California. I'm in Chino Hills. Where I look at when I invest, I look at a couple of things. One of them is like job growth, population growth, and typically some people, they like school, convenience, so closer to the market and things like that, right? So in terms of major city here, let's say in SoCal, I would say where people are moving to would be like Chino Hills, and like Ontario, Eastvale, and all along the 210s, like and if for the SoCal market, that's where people are looking at. I would say actually people are looking at Long Beach too. Price been going up quite a lot over there in that area. Yeah.
Jack, Wang, do you have any insights on areas to invest in around here? Oh, okay. We are having some issues on his end for unmuting.
He's muted.
Okay. Is okay with me?
Yes.
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 I cannot see it.
What are some towns or areas that you think we should invest in? The people here should invest in Southern California or nearby California?
Okay, how much do you really need a step of the purchase? But
how much 你这附近有没有一些地方你要 invest 比较好一点？可能现在没有那么多 saturated， 可是
Okay, I know. For the Irvine is very good investment, but you need to know the area. Okay, like a Great Park, they have around like a 2% for tax rate. The 1% for the property tax, 1% for the mail rules. So if you live in there, it's great. But investment, I never help my client for investment client to buy the Great Park, because the new building in Irvine, they have the special tax, like we call mail rules. So that's very important for the cap rate. All right. So, and also I say that how much you need the step of the purchase, I say you have to ask for your loan officer. Why? Because I had many clients, they only $5,000 for the checking account, but they can buy 1.5 million house. Why? Because their income over 300,000. So that depends how much you need to save. It's asking your loan officer. It's very, very, very important. And the tip of the choice, the realtor, just for the example, okay, I have a client, they use the other area to want to buy the Irvine, but very hard, 10 years, they cannot buy it. Until they find me, I use like a 10 hours, help their kid to find the Northwood High School, buy the new house from the Irvine company. Also, I help them to lease apartment, okay, without break the lease. And also at the nighttime, I help them to like apply the all utility and buy the new car. So they live in the Marriott, find me, and next day they move in the apartment. So that's I very strong recommend. Use the local agent. They know everything. Use the local agent. that's easier to help you find your dream home. Okay?
Great. Thank you both Jack Tsai and Jack Wang for helping answer this question. Jack went a little bit into if I don't like the realtor I choose, can I find another realtor? Do you, Kevin and Jack, have other insights in that?
Yes. If you okay, go ahead.
That's my short answer. Yes. Yeah, go ahead.
There we go. Okay, perfect.
You guys say you got a beautiful name. Go ahead, Jack. Go ahead.
Jack Wang, do you want to add onto it more, or yes is a good answer?
No, that's okay. I'm finished. So you can ask.
Okay, sweet. Then we're going to be moving on to the next slide, and that one is going to be for financial, because money is important when buying a house. So how to choose a lender? We did go over this briefly. Maybe Olivia can answer this question. What are things to be considered besides the rate when you're choosing a lender?
Okay, choose the lender that you feel comfortable with and you really trust. After discussing your financial situation, your financial needs, your down payment. So through the response in regard to your financial needs, you will find out if you feel trust with the lender and if the lender is knowledgeable. So that is very important. Choose the lender that is knowledgeable and professional, and he could answer all the detail in regarding your financial situation and your credit issues. Many things that when lender calculate your payment ability, usually they consider positive and negative factors of your credit issue. You may don't understand why they want to see that, but unfortunately, all of the information, including positive or negative in your credit report, is a very important factor. So a knowledgeable and understand your situation, financial situation lender is very important. And he can go through every step by step your closing process. And that is important. That's a critical factor that you have to consider with a trustable lender.
Great, thank you so much, Olivia. And maybe others can chime in as well, but what are some first-time home buyer programs that maybe you help your client with often, and how are they different compared to conventional home loans, would you say?
As I have mentioned about the first, I would suggest you go to the website from the HUD, that you can understand if you have issues, credit issues, or you have a problem in the down payment. They have all the Q&A. So go to the website first, and then first time home program, there's two. One is a government guarantee. The second one is the lenders, so convention loan. So most of the bank, they don't do the government guarantee mortgage, but they did do the convention loan with the mortgage insurance. So there's a lot of websites that if you are looking, of course, if government guaranteed a loan, you will cost a lot of fees on that, and the rate is pretty high. So you can also Google it. If you don't want to go through the government guarantee loan for the first time home buyer, you can talk to any lender in regarding convention loan and with the mortgage insurance paid. That's also help. The difference is the convention home loan from a lender is lower cost for the mortgage insurance, and it's easier, and you don't have to go to the class, because if you go with a government guarantee loan, you have to take a certificate of the first-time home buyers that you qualify. And you have a tech about, I believe, about 20 hours class. I am not sure because things change. But if you go through the convention loan with a banker, with a lender from a bank, you maybe take 1 hour or 2 hours, got a certificate of mortgage insurance. I think it's 1 hour. That's the difference as well.
Got it. Thank you so much, Olivia. So take her advice. Make sure to know what's best for your situation. Ask the lender, use the link in the chat, and find it out. And our third question for financials that was most common is, what are all the fees associated with purchasing a home? And Kevin went over this pretty well, so we're going to move on. But as a recap, there's items such as monthly PITI, closing, loan fees, minor repairs, as well as having a reserve just in case something accidentally pops up that you're not expecting.
Can I chime in a little bit on that?
Yes.
So basically all the fee depends on the purchase price, obviously. And I would say just prepare about like 0.5% to like 1.5% of the purchase price, like loan fee and inspection, everything like that. And so if you guys want to have like a detailed list as to what everything is, you can email me. I have a buyer's package where it lists out basically like a average of like based on what you're looking for about purchasing a home or even selling a home. I have a listing package as well.
Nice. That's awesome. Thanks, Jack. Okay, and then the next slide is more of a timeline, very much judgment-based. For our realtors, speakers, would you say there is a proper time to invest in a home? Or when would be a proper time to invest in a home?
I would say they say there's a phrase that don't wait to buy real estate, buy real estate and wait. So my take on that is that whenever you feel ready, and there's deals, depending on the market, right? If there's low inventory, when the market is hot, there's you have when the price is too high, you have to look at, if you're looking to hold, buy and hold. No matter which market you're in, just know your number, know how much rent you're collecting, how much money you're filling out for every single month, every single year. So that way you can invest. And right now though, because the market is very hot, and usually we're on the 10-year cycle. So in terms of investment, I'll be like right now it's a little bit. It's I would say have more margin in whatever you're looking at, just in case. Like whatever property investment you're doing, have an exit plan. So that, if market, if you're not gonna sell, I mean, because every property, if you hold it for long term, you'll always go up due to inflation, and inflation is coming. Actually, I think it's there already. I was talking to a friend yesterday. They were talking about cigarette. They were like, right now it costs more than $10 to buy a pack of cigarette. I'm like, what? I remember a couple of years ago, when I was at a gas station. I don't smoke cigarette, but like I remember it was like $4 or something. Right now it's 10. So I think more than 10. So just know your number, have an exit plan. If you're looking to hold long term, just as long as your number doesn't matter. But you're flipping, have more margin.
That's some good advice right there. Would you say, what are your thoughts on then buying a house versus renting? If you don't know if you're going to be in the same area, would you just put it down and buy a house, and then in the future, if you decide to change your mind?
I'm Olivia. I can step in for this question. So when is a good time to buy a house versus renting? Well, the rate of the mortgage loan has never been so low in America. So a lot of my clients, they approach me and asking about the same question. So you will look at your financial situation, your salary, your income. So as what I have mentioned in my presentation, you can choose adjustable rate for maybe 5 years fixed or 3 years fixed. And I would suggest that people always buy, if you are not sure how long you will be stay there, don't buy a big house, buy a lower price a house. And then when you decide to leave, you are easy to sell it because the price is not high as million. And also you can easier to rent it. And why the market right now is so hot? Because the mortgage rate is very, very, very nice. Couple weeks ago, I do a lot of loan. The rate could be a purchase loan could be 2.5, 2.7 for 30 years fixed. For rental property could be 2.9 or 3% for 30 years fixed. So if you don't know how long you will stay, it's a good time right now. You could choose the 5 years fixed. So that's my answer.
Awesome. Thank you so much, Olivia. Now that we wrapped up all our common questions, I'm going to be going into the questions from the chat. We did have some help in people helping in answering. So unless you guys, the speakers, have something different to say, then I will just be moving it pretty quickly. So hopefully we can get it all in by 1 p.m. and have it all wrapped up. So from Christine, she asked, how long does a pre-qualification last for? Does it vary from lender to lender, or is there industry standard? And David replied 3 to 6 months. And do you guys want to add anything on to that?
I beg your pardon, what is the question?
How long does a pre-qualification last, and does it vary from lender to lender, or is there an industry standard?
Okay, usually a bank, the pre-qualification letter is last only for 60 days. And yes, based on different property. Sometimes when you approach the bank, you show the subject property that you are interested in. The lender will calculate and give you a pre-qualified letter. But maybe 30 days later, you find another property that have to recalculate it. So every time when you find a property, you better talk to your mortgage loan officer. They always can do the pre-qualify again for you, subject the property you are interested in.
Got it. Okay, so you got to be pretty fast then if it's only 60 days. I guess it ties really nicely into the next question of, does having more cash or having cash on hand to buy a house make a buyer more appealing to the seller versus a buyer with less cash? And Gary replied that cash is great if the seller wants to get the house sold fast. But does any realtor have something to say about that as having cash?
Yeah, I
was versus not. Sorry, yes, Jack.
Yeah, I would say yes and yes in most cases. And like what Gary said, I also work with Gary, so he's a great agent. And just we have to reverse our role and think that if we're the seller, what does the seller want? At the end of the day, after closing, it's the money. It doesn't matter if it's loan or cash, right? But the seller would think that if it's cash offer, there's less contingencies. What contingency is like opportunity for the buyer to back out, to do their inspection, to their due diligence. And so not having to worry about buyer being able to qualify for a loan or appraisal issue, like what Kevin was talking about, that does make a cash offer more appealing. So the question would be, if you're a seller, if you get an offer $500,000 cash, but you get a $530,000 loan, would you be willing to take $30,000 less for less risk? Or would you want to wait for like 10 to 14 days to see whether or not the loan will go through? So it helps in most cases, but in this market, like all the buyers, all the sellers, a lot of the sellers are looking for offers that's waiving loan contingency, appraisal contingency, meaning like the buyer is not gonna say it doesn't appraise, so I'm not buying it, or I try to renegotiate. So it helps, but not like it kind of helps.
Got it. Thank you so much, Jack. Since we have about 2 minutes left and to give everybody back their time at 1 p.m., I'm going to have one last question that has not been answered in the chat yet, which is from Angela. Do you also invest in REITs, which is a real estate investment trust, essentially a publicly traded company that owns, operates, or finances income producing properties? What are your thoughts on investing in REITs as anything.
Yeah, I mean, that's definitely one option. It's a way to create passive income. And so I would say in terms of investing through REITs, like know more about the market. I kind of look at it like if you invest into REIT, you're kind of investing like stock kind of thing, you know, because if there's a lot of REITs that's publicly traded on the NASDAQ, and that's one way to do it as well. But like I said, like just know your end goal, so that way and make sure you allocate money for investment so that we don't have to work forever.
That's a great perspective right there. Awesome. Well, with 1 minute left, I'm just going to wrap up this meeting. Thank you guys to all the attendees for coming, and especially to our speakers for coming in to speak, answering the questions, and the people in the chat helping out as well. Thank you so much for your time. I hope you guys learned a lot. We have a survey right here, which if you can click on, screenshot, take a photo, type in really quickly and fill it out, that'd be super duper helpful. I hope you look forward to our future events, and thank you. Here we go, and thank you so much.
Thank you.
Thank you for the opportunity. Thank you, everyone.
Yes,
Thank
thanks.
you.
Yeah, thanks for the opportunity, guys. I appreciate it.
Thank you. Bye-bye.
Yeah, we'll be sharing the slides at the end. So stay tuned, check your email. Yeah, if you have any questions for our speakers, you can definitely fill it out in the survey and we'll get back to you.